Good morning, everyone, and welcome to Pillow. The big news just came out yesterday that Liz Truss, the Prime Minister of UK, she just resigned. And I was like surprised because she was in her position for 6 weeks. And then as I go through, I realized that, oh, wow, the economic situation and financial well-being of the country actually have a power to fire the prime minister of the country. And so I think today is a good opportunity to have Alpha, our CIO, to elaborate on that a little bit. But we are trying to dumb this down into informal language because I know that when we listen to the news out there, sometimes we get lost in the number and we get lost in the technical terms. So Alpha, can you give us like the background of what happened in financial landscape in UK right now that lead to yesterday resignation?
Hello, Sarah, and hello, everybody. Thank you and welcome from France, where I arrived a couple of days ago. So, yeah, Sarah, there are, I think, 4 dates that are important to remember here. Number 1 is September 6th, which is when Prime Minister Truss, former Prime Minister now Truss, became Prime Minister. September 23 is when she and her Finance Minister announced a $45 billion unfunded tax cut budget. October 14, last week on Friday, was when she fired her finance minister, and yesterday, October 20, is when the market essentially fired her. Okay, so those are the 4 important dates to keep in mind.
Yes. So, yeah, what's really happening with her with her financial policy? I know that she reduced the corporate tax. Like, yeah, can you tell us more of how many things she does that the market did not like?
Sure. So, as you know, the world has an inflation problem. Inflation is high everywhere. In the UK, it's about 10.1%.
10.1.
So meaning that the UK is suffering. So the Bank of England, like other central banks, has been trying to reduce inflation. And the way to do that is you lower demand in the economy, because inflation means more demand than supply, right? So you try to, because you can't increase supply, it's hard. You can't build, enough bridges, enough manufacturing and stuff like that very, very quickly. So the easiest way to do that is to reduce demand, and you reduce demand by raising rates and taking liquidity out of the economy. That's what the Central Bank of England, has been trying to do. So now comes Truss 6 weeks ago, and she says, "Oh no, we don't want to do that. We're gonna cut taxes and increase subsidies for energy consumption." So by doing that, she effectively increases demand in the economy. So she's trying to increase demand. The central bank is trying to lower demand. That's the problem, right? It's inconsistency. And her fiscal policy includes 45 billion pounds of unfunded tax cuts. Unfunded meaning she has to go out and borrow the money she needs to, because obviously lower tax cuts means lower government revenues, and higher spending means higher spending. So you have to get the money somewhere else. So she was going to go and borrow the money. Problem for her is that the markets revolted. The market said, no, this is crazy. You have an inflation problem, and you're going to make it worse. On top of that, your policy costs you 45 billion pounds, and you don't have the money. So you're going to come to us to borrow it. And so the market sold off government bonds, UK government bonds.
So I want to stop you here just for people who might not understand. So government, when they don't have money, they will issue the bond and sell it into the market so that they can get money. But now the market sold the bond because the market feel like, oh, this is not a good idea. I don't want your bond anymore. So the market sell the bond off. But now the government want to issue more bond and put in the market. It's like, I want money from you, but there's no buyer. So that's right. Exactly. So in the easy way, that is what happened.
That's right. So the market saw a huge borrowing coming from the UK. So what they did was they sold off the bonds, and what the technical of bonds is that when prices go down, yield goes up, right? So the yields in the UK bond market, called the gilt, the UK gilt 30-year Treasury bond in the UK went from about 1.1% at the beginning of the year to 4.39%
Big jump.
right now, right? And so if you held a UK bond from the beginning of the year, you lost 40%, 40, versus UK stock market down about 18%.
Right.
The British pound is down 18% against the US dollar. So essentially you lost double from bonds that are supposed to be, cash proxy, liquid, safe havens, not volatile investment. You lost more from those things in the UK than from stocks and the pound.
So as these go along and getting worse, what would happen?
If they had continued, okay, so if they had continued, what happened with with higher rates? Three major things happened with higher yields. Number one, the homeowners would have to pay higher mortgages, because obviously higher rates means higher mortgage yields or rates. Sorry. Number two, there was the pound was coming down because the pound was getting sold by international investors. The UK is not a very big economy; it's like 4% of the global stock market, for example, right? So people don't have to own UK paper. So they were selling UK assets. And then number three, and probably most importantly, the pension funds in the United Kingdom was close to getting bankrupt.
Right.
Because what happened was they were using, we don't want to make it too technical, but they were using a strategy called LDI, liability-driven investing, which uses derivatives. And so when yields went up, there were margin calls. The counterparties to the pension funds were asking them to post more cash as collateral. So pension funds did not have that cash. So they had to go around selling assets to raise the cash and put it as collateral against their position. And so they were selling, UK stocks, UK bonds, and UK, assets.
So let me project it further. So if the UK government cannot pay pension, what would happen?
That's the surest way for a politician in developed markets or developed countries to get fired, because UK's senior population, those above 65, represent 20% of the population. But the problem is they all vote. Younger people don't vote, but the seniors always vote. So if you are a government and you don't take care of the seniors, you get fired like tomorrow. So that's what happened. Then last week, Truss had to give the market a scapegoat, right? So she fired the finance minister, but that was not enough. She put in a new finance minister, Jeremy Hunt, who on Monday, I think Monday or Tuesday, announced that, okay, you know what, we're not going to do these tax cuts. We're not going to increase the subsidies. So basically, he reversed her economic policy. But the problem is that now her credibility and competence were being called into question, and the Conservative Party in the UK decided to fire her because she couldn't continue to lead the country. So now she's become the second shortest tenured prime minister in UK history. She damaged the credibility of the UK. We don't expect a bond default from the UK. The last default was like 300 years ago, in 1672, right? So we don't expect that, but definitely there has to be now a risk premium for competence on owning UK assets, right? On the bond side, it means higher yields. On the equity side, it means higher discount to global stocks.
Wow. So finance and financial well-being is so important to us and also for the country. And I think this example really hit me and hit everybody on the face that yes, financial well-being have a power to break the country or break the power of a person. The same thing that is have power to affect our life, our family. So I hope that everybody who listen to this can go back and reflect and just start to look at how is our financial well-being as a family. And if you have any more questions, please leave the comment below and reach out or text us. We'll be so happy to discuss this topic with you. And then I guess we will see everybody again in the next video. And Alpha, I will see you when you get back to Canada safely, my world traveler CIO.
Sure. I think just to finish there, I think there are three lessons that I draw from this. Number one is if you're not the US reserve currency, you have this exorbitant privilege, as just Countess Stan said. So if you're not the US or you're not China, China has $3 trillion of US reserves and a closed capital account. So if you're not these two countries, everybody else, if you need the markets, you gotta be respectful of the markets. You gotta respect the market, and you gotta make sure you act, you enact a credible and disciplined macroeconomic policy. That's lesson number two. You gotta be macroeconomically competent and focus on the biggest problem we have right now, which is inflation. Lesson number two, right? And then lesson number three is you got to invest for the long term. As a as an individual, as a family, as a government, but you got to invest within the constraints you have. You can't keep spending more than you earn.
That's so true. Like actually, there's a video from last week that Alpha did on how to invest in Africa. There's a lot of important message in there. So if you haven't watched, I invite you to go and watch that video. And I feel like this event of what happened in UK is open so many topics that I feel like we can discuss later on about capitalism. People are kind of like, oh, this is bad. It's actually not bad. There's some good about it. I think we can have the next discussion and the next video that will be coming up for all these kind of topic. It will be interesting. Thank you for watching, and I see you in the next couple of days, Alpha.
Thank you so much. Take care.
Bye.